Picture this. You've done everything right. You've spent 2 decades paying down the mortgage, the lawn is manicured, and you finally put that for sale sign in the front yard. Within 48 hours, you've got a buyer. They've got the credit score, they've got the down payment, and they love the kitchen. It's a slam dunk, right? Well, fast forward 2 weeks and the whole deal just evaporates. The buyer didn't back out. The bank didn't go under. The problem is a piece of paper that didn't show up. Your home is suddenly uninsurable. And in 2026, if you can't get insurance, you don't have a sale, you don't even have a tradable asset. You've got a very expensive, very stationary liability. Welcome to the actuarial apocalypse.
Here's the deal. Insurance is the invisible glue that holds the entire global economy together. Without it, the gears of the mortgage market simply stop turning. And right now, that glue is dissolving. We're looking at an average US homeowner's insurance premium growth that's hit 34.2% in just 3 years. The national average has climbed to $2,500 a year, and that's if you're lucky.
In some markets, it's not even about the price anymore. It's about whether anyone will take your money at all. We saw the first real cracks in May 2023 when giants like State Farm and Allstate just walked away from California. They didn't just raise rates, they halted new policies entirely. They looked at the wildfire risk, they looked at construction costs, and they decided the math just didn't work anymore. And when the math stops working for the biggest insurers in the world, it's time for us to start paying attention. It's a phenomenon I'm calling the un-tradable asset. We're reaching a pivot point in early 2026 where insurance premiums are projected to hit 9% of your total monthly mortgage payment. That's a massive jump, 120 basis points in just a few years. For the first time in history, for many coastal homeowners, the check they write to their insurance company is going to be bigger than the one they write to the tax collector. Think about that next time you look at your escrow statement. This isn't just a headache for people with beach houses. It's a systemic shift that's changing the very nature of what it means to own a home in America. The dream is getting priced out of the market, not by interest rates, but by the cold, hard reality of risk management. So how did we get here? It's not just that the weather is getting wilder, it's that the industry has found a new way to see the world. We've moved from guessing risk to seeing risk with terrifying precision. I'm talking about algorithmic risk modeling and high-resolution satellite analytics. It used to be that an insurance adjuster would walk your property once every decade. Maybe. Now, there's a satellite 400 miles above your chimney that knows exactly how many shingles are missing and how close that oak tree is to your bedroom window. This is what the industry calls surgical exclusion. They aren't just dropping zip codes anymore, they're dropping individual houses based on data points you didn't even know existed. Let's talk about the roof age trap. This is one of the most brutal mechanisms at play right now. If your roof is 15 years or older, you're seeing an automatic decline from private carriers at a rate that's up 400% since 2021. The AI scans the satellite imagery, flags the wear and tear, and boom, your policy is canceled. No human ever stepped foot on your porch, and here's the kicker. Once you're dropped, you can't get a mortgage. Fannie Mae and Freddie Mac updated their guidelines in 2025 to strictly enforce continuous coverage at the closing table. No state pool exceptions allowed. If you can't find a private carrier to back that 15-year-old roof, your buyer's loan gets rejected. We're now seeing 4.5% of all failed home closings tied directly to uninsurability. That's a 300% increase in 3 years. Let that sink in. This is the part I find wild. The precision is so high that it's creating a 2-tier housing market. On one side, you have the algorithm-approved homes, new construction, metal roofs, zero brush proximity. On the other, you have the actuarial outcasts. These are perfectly good, beautiful homes that have been surgically excluded from the financial system, and because they can't be mortgaged, they have to be sold for cash. And when you're selling to a cash buyer, you're usually looking at a massive discount. Your $1 million home might only be worth $600,000 to someone who doesn't need a bank. The value hasn't changed because the house got worse. The value changed because the algorithm decided it's no longer a safe bet. It's not a house anymore. It's a data point with a bad score. Now let's zoom out for a second, because this isn't just happening in your backyard. This is a global financial web, and the vibrations are moving fast. When you pay your premium into an escrow account in Florida or California, that money doesn't just stay in a local vault. It flows upward into the massive, shadowy world of global reinsurance. And the folks in London and Zurich, They're demanding much higher returns for taking on American climate risk. Look at catastrophe bonds. These are high-yield instruments that investors buy to bet against disasters. In 2024, we saw a record $15 billion in cat bond issuance. Why? Because the yields are hitting 12 to 15%. Investors are making a killing because they know insurers are desperate for capital. This desperation is visible in places like Florida, where the insurer of last resort, Florida Citizens Property Insurance, has ballooned to 1.3 million policies. That's a 110% increase in 3 years. The private market capacity has essentially collapsed, leaving the state to hold the bag. But even state-backed plans have their limits. When the last resort becomes the only resort, the entire system becomes incredibly brittle. This is where the story takes a turn you might not expect. As the traditional banks and insurance companies retreat, someone else is stepping into the vacuum. I'm talking about alternative asset managers and private credit funds. There is currently $1.7 trillion in institutional private credit AUM, and a massive chunk of that is starting to pivot toward what they call climate resilience debt. By January 2025, we saw giants like BlackRock moving into this space. They aren't offering you a traditional 3% mortgage. They're offering high-interest bridge loans to homeowners in high-risk zones who have been abandoned by the traditional system. They're essentially replacing home equity with double-digit debt. They use their own parametric insurance to hedge their risk, while you're left paying 10% interest just to keep a roof over your head. The hidden beneficiaries of this crisis aren't the insurance companies, they're the private credit funds that are turning your home's uninsurability into their next high-yield profit center. I know sounds dramatic, but look at history. This isn't the first time the insurance world has faced a reckoning. Back in 1906, after the Great San Francisco earthquake and fire, the industry was at a crossroads. Lloyd's of London famously paid out every single claim, regardless of whether the damage was from the earthquake or the subsequent fire. They did it to build trust. They knew that if the market didn't trust the insurance, the market would die. That move birthed the modern reinsurance industry and kept the American West liquid for over a century. Trust was the currency that kept the wheels turning. But fast forward to 2026, and we've swapped trust for data. In 1906, the solution was universal coverage to stabilize the market. In 2026, the solution is parametric fragmentation, using data as a weapon to exclude risk rather than a tool to share it. Jerome Powell, the Fed chair, even flagged this as a slow-moving systemic risk in late 2024. He's worried that certain geographic regions could become permanently unmortgageable. That's a fancy way of saying those places will effectively disappear from the modern economy. We're debating whether we're in an insurance bubble right now. Matthew Eby from the First Street Foundation argues that we're looking at $1.6 trillion in property value that could just vanish as valuations finally start pricing in the total lack of affordable insurance. 1.6 trillion, let that ratio sink in. Of course, not everyone is a bear. Lawrence Yun over at the National Association of Realtors thinks the housing reset will eventually level out. He argues that income growth will catch up to premium hikes and that state-backed plans will bridge the gap until new tech makes insurance cheaper again. But honestly, that feels like optimistic thinking in a world where the algorithms are getting more aggressive every day. We're seeing a fundamental decoupling of risk and liquidity. For the last 80 years, we assumed that if you owned a house, you could always sell it. We assumed the risk was shared by everyone. But the new map of the American dream is being drawn by satellites, and it's a map where your assets can be deleted from the market overnight. So, what does the future actually look like? It's a world where universal homeownership is replaced by a calculated landscape of risk. We're seeing the rise of the parametric insurance market, already a $21 billion industry, and growing at 13% a year. This isn't your grandfather's insurance. It doesn't pay out based on your damage. It pays out based on a trigger. If a Category 3 hurricane hits your GPS coordinates, you get a direct deposit in hours. No adjusters, no arguments. It's hyper-efficient, blockchain settled, and it's likely the only way you'll be able to get coverage in high-risk zones in the future. But it's also expensive and specific. It covers the gap, but it doesn't solve the underlying problem. The reality of 2026 is that the days on market for homes in high-risk zones have jumped to an average of 95 days. That's up 55 days in just 3 years. Liquidity is drying up. We're entering an era where the value of your roof is no longer determined by the view or the neighborhood school district. It's determined by the cold algorithmic gaze of a satellite 400 miles above your head. The social contract of homeownership, the idea that a house is a safe, tradable store of wealth, is being rewritten in real time. The value isn't in the bricks and mortar anymore, it's in the data. So next time you look up at the stars, just remember, one of them might be deciding exactly what your home is worth. And it doesn't care about your marble countertops. It only cares about the math.